Hello traders, welcome back to another episode of the Traders Show. This is episode 12. We're going to have a very short episode. Why? Because we had some things taking up our time, so we came into the studio quite late and we don't have enough time to talk about many things. However, we'll try to cover as much as we can in the little time that we have remaining, and hopefully you'll learn a thing or two. So the topic for today is handling drawdowns, account blowups, and taking losses. So there's the dark side of trading, the side which no one posts about on social media. Rarely do people post after blowing an account. Rarely do people post after taking losses. We often hear of the successful stories in trading, but trust me, we've heard of a lot of bad things happening in the market because of some simple mistakes, or you just didn't understand what you are doing. So that's what you're going to talk about. My name's Ken. I didn't introduce myself when I was starting out. So founder, Financial Hub, and I'm joined by my good friend and colleague, Lawi. So he'll introduce himself and then we can kick off. Lawi.
Greetings traders, listeners everywhere on all platforms. It's a beautiful Thursday. We are shooting another episode for you guys. As Ken has said, my name is Lawi Tarus. As Ken has said, I'm a risk manager here at Financial Hub and a mentor. So I enjoy sharing my thoughts about markets with students, listeners, and just everyone who is interested in markets. So today, as Ken has said, we're going to talk about account blowups, which I think 99% of people who have tried trading or who have deposited some money have faced that consequence of trading. We're also going to talk about taking losses, which is a main problem for many traders. For many of the people in life, they don't like taking losses, being failures, and managing drawdowns. So those three topics will be the main ideas for today. We are going to dig deep, not so deep because of time, but we will try and deliver what we have in store for you guys. So it's been a beautiful week. Okay, not very beautiful week, a slow week still for me. I've had about three trades, 2 are running, 1 loser on pound yen.
Which 2 are running?
Dow and
Dow. We have Dow shorts and oil shorts.
Dow shorts and US 500 shorts.
Okay.
I have those 2 positions. So let's see how the week will end. It's the end of July, so by tomorrow we will know how the end of July comes and we'll bank our profits and losses. So that's it for the intro. Let's get into the meat of the topic. So can you start?
Yep, market update. I think it's important for us to talk about what happened this week. Yesterday we had the Feds. The Feds are talking. Rates unchanged.
Yeah, rates
Purchasing programs unchanged. Nothing really has changed, and markets are pricing in that information. You can see a market like gold jumping up 1%, breaking out of the long consolidation at the 1800 level. We're now trading at 1825. We could see highs of 1850, 1875 over the next few weeks. So I think there's some upside potential. There are some opportunities to be capitalized on to the upside. GBP USD recovering back from the collapse we had some time back. We are now trading at 1.396, getting close to 1.4. The Dow back to 35,000. We're now trading at 35,100. Oil $72.6 a barrel, coming back from $64 a barrel last week. Nasdaq new highs 15,000. That's where we are currently trading. The dollar moving quite low. We're now trading at 92, down from 93 point something. So I think that's important. Bitcoin coming back to trade at 40,000. Ripple trading at 70. Ethereum trading at about 2,200. I think that's enough from our end. Now I'll start off. Obviously, I've blown an account. My first account blow up was actually a joint account. So we were trading it 3 people. We were making decisions, all of us in the account, and unfortunately when that's the case, that's a recipe first of all for an account blow up. So what did I do after blowing up that account? I decided to go back and study as much as I can. For me, an account blow up meant there's something that I was doing that didn't make sense or that didn't add up, or there's something that I had not understood about how to trade. Initially, at the moment of blowing the account, I think there's a lot of pain, because you can imagine, probably like for the first blow up we had not even withdrawn a coin.
Despite having seen about 300-400% returns.
Exactly. So you start out with a small account, you double, triple, sometimes even quadruple, and then what happens? And you have not withdrawn not even a single coin. And that's why I think people go wrong, first of all. Anytime you're trading and you're making profits, please take off 50% of the profits. Enjoy. You're doing trading not with the intent of compounding too much, but also living off it.
Yeah, living off it.
So if you've made 100,000, take off 50,000. If you've made 300,000, take off 150. If you've made 3 million, take off 1.5. Enjoy that also, because we've seen stories of people blowing up after very good runs in the markets without taking any profits in the market. So the first thing that I'd advise you is you're trading your account and you're making profits on a weekly basis, take some profits off the market, off the table. Ensure you just have your limits, and then you can keep on taking some money out of the market, because that's what you do as a trader. You take advantage of the opportunities in the market to make money, and then you enjoy that cash, or you invest it in other things.
Yeah.
So I think that's why I can start first of all.
Okay, for me, I also start from the same point of view. From my first blow up, it was a joint account with Ken and one of our other friend. So that was the first account we had. We didn't have a lot of knowledge. We had just read like one book. We thought we knew how markets work. We thought we had it. We were trading one strategy.
What do you think?
Gap close.
When you look back, how foolish were you on a scale of 1 to 10 to make some decisions?
Okay, I don't think I was foolish. I think I was just arrogant and ignorant.
Ignorant is the one.
Yeah, like I didn't have
the right information.
Yeah, the right information, and I was doing something thinking I know that how it works. So
yep.
Yeah, I think the first reason why we blew the account was basically purely lack of knowledge. So the fact that we had some
that
knowledge,
was the main reason.
The main reason.
It's not we never knew what
we never knew what we were doing. We never knew how markets worked. We never knew the risks involved. We never knew how to handle loss traps. We never knew how to handle.
We even never knew something called.
We never knew a loss trap exactly. So it was just purely a gamble for us. Yeah. So for us, starting out, we were gambling our money in markets, but through the gambling, we saw an opportunity.
Yeah.
Multiplying 300 to almost 30,000 Kenya shillings to about 120,000 Kenya shillings in about a week. I don't think there's any business that can multiply money that fast.
None whatsoever.
Maybe gambling. Yeah, but it really showed us here is an opportunity.
Yeah, true.
But okay, I think the good thing is we stuck to it. After blowing the account, is we had seen it was a revelation to us, you guys, there's money here.
Yeah.
And the fact that there's money here and you've blown an account too fast to even learn, now we had to go back to the drawing board.
Yeah.
Not even look for money again. Money was not even our interest. So it was just now looking for information.
Yeah.
Trying to find that knowledge. So I think that realization of the main reason why you blew an account, because we did we didn't even deposit money a week later, a month later.
Yeah,
we went into a spree of reading. Yeah, reading markets, watching markets for long hours, reading a lot of books, market wizards, learning from those pros.
Yeah,
and slowly you start to understand. This is not what I think. This is not what I thought trading really was. So
okay.
It starts changing your mindset.
Yeah.
And now you start developing the mindset of a trader, pole. As you just begin your own trading, your trading mindset starts developing. And I think that's where now you start, at a shallow point, you start developing your career plan.
Yeah.
Without even knowing you're developing your career plan. But you start just getting serious about it. That's the first step.
Yeah.
Do you decide to get serious about your trading? Because I think most people who have blown accounts, and I think this is the analogy of how blow-ups work. It comes with a feeling that you're good first. You feel you know how it works. The market fools you first.
Yeah.
So you know this. it's easy, it's simple.
Mm-hmm.
Then you think you know it. Then in a flash of a second,
you don't know it again.
You don't know it. And the reality is so evident. Like you lose money, you lose like mental peace, emotional peace. You can't talk to your friends. So like you just want to be alone, maybe reflect on what's going on. So I think like first of all, like what really helped us after the first blow up was the fact that we became serious about this thing. Yeah. For most people, I think why most people actually blow accounts and don't even come back is because they don't try to become serious about trading after realizing, after losing their bankroll. You see, someone loses his savings. Instead of them going back to the drawing board and trying to look for the main reason why they blew the account and seek some other advanced knowledge that maybe the book he read or the book she read couldn't have given him or her. Now this person, either he quits or deposits another money, thinking it was just a mistake. Like maybe like you blame it on one single mistake.
Okay.
And like the main mistake why you blew your account, especially as a newbie, is because like 99% of things you're doing are wrong, not 1%. So the fact that you realize that I didn't make a small mistake. It was a number of mistakes accumulating, psychological, risk-wise, strategy-wise. So like that giving yourself time now to understand how markets work will save you a lot from blowing the second account. From blowing the third account. Like after blowing the first account, it comes like it's a bag of losses. It's not only like money lost. It's money lost, but you have a bag loss, like a bag of losses on your back. So like scrutinizing that account blow up. Then coming back later, even if it's a month later, 2 months later, back to the markets. Still you won't be that good because you'll maybe have solved a few mistakes. Mistakes in trading, even for pros, they're there. So you can never eliminate 100% of the mistakes. So I believe like just giving yourself that slow path of learning how markets work is the first step to minimizing the number of accounts you blow.
Okay.
So because for me, I believe if you don't do that, you'll blow very, very many accounts.
And cycle of doom.
Cycle of doom. And after like 2, 3, 4 account blow-ups, many people now start saying this thing doesn't work. But it didn't work because they didn't solve the root problem.
And there's the idea of having proximate causes and root causes.
Exactly.
So rarely do people look for the root cause of why something happened. Like you blow because you over-position sized. Okay, you over-position sized. But why did you over-position size? You over-position sized because at first you didn't even understand what is position sizing. And which position size to use for your account. So it's not really that you over-position sized. That's the proximate cause of blowing your account. But the root cause is you don't even understand how to position size.
Exactly.
And if you do that again, you use another account, you'll come back and repeat the same mistakes. So it won't change much. Yeah, exactly. The second thing that I think we can talk about is the loss trap. So besides lack of knowledge and not knowing what you're doing and the challenges of the markets, which can be quite challenging for everyone, even the pros, like Lavi said, I think there's the aspect of brain freeze, like you're in a loss trap, you're trapped. Because the subject of this, the topic for this podcast was taking losses, handling drawdowns, and account blowups. So taking losses is not something that comes directly to us. And I think the research done by Daniel Kahneman and Amos was a perfect example of how people make decisions under risk and uncertainty. In that people are more willing to secure a gain and they are more willing to risk a loss. Exactly. So they do the opposite of what should be done in trading. That's human nature. That's how you're wired. So before you understand that, most people who blow up accounts, what happens? There are two things. One, you're either over-position sized, which that's a lack of understanding, a lack of not knowing how to position size, not understanding risk, a gambler's mentality. There are many things behind that. But now there's the loss trap. You did your position sizing well. You took the right trade. This was a very good setup, but it just didn't work out. And now instead of cutting the loss at the point where you decided, you decide to hope and to pray that it will come back. And that's where you get trapped and everything goes south.
They say most traders become fearful when they should be
hopeful. and hopeful
when they should be fearful.
That's the thing.
So like whenever you are in a loss, you should be very, very fearful that this loss will continue being a bigger loss.
Exactly. And it gets bigger very, very
But at
fast.
that point, that trader does not want to be fearful. Now he's hopeful. And
Exactly.
This $20 loss,
Please
go back to 10.
Yeah. And then 5.
And then 5. And then I'll break even. He's very hopeful. Instead of being very, very fearful,
that
this
the
$20 loss will go to 30 and 40 and then 50, 100.
Yeah.
So like that psychological wiring is not with us, like as humans.
Yeah.
You always want to hold into a losing position, into a bad career longer, because it gives you some sort of security.
Yeah.
Like you don't want to like expose yourself to that danger you're actually facing. You see, you're actually in danger, but you don't want to accept you're in danger.
Yep.
Instead of accepting it, cutting it very fast and
Moving
minimizing
on.
it. Exactly.
Yeah.
Also, it happens on the opposite side. A small win, banked. Another win, banked.
Like you don't want to be objective in how you manage your trades.
You don't want to hope that your trade, which is already winning, will become a bigger win. Now you're very, very fearful that this win will
be taken out
very fast. And that psychologically makes you close winners fast and hold on to
losers
longer. And that's a loss trap.
Most people are not aware that they do that.
It's very, like subconsciously you don't know.
Exactly. Like if you really have to think hard and reflect hard on some habits for you to understand that, listen, I'm making some emotions. I'm making some emotional decisions.
That reflection comes in after that blowout.
Exactly. It doesn't come in without losing money again.
Like before you blow account, you always think you're rational. But after you blow in, I was making some mistakes very, very foolishly.
Exactly. I was making some irrational decisions. So I remember particularly for me, there's the Euro yen position I had. And that was the second blow up I had. And I think the last one that I had. So I took some Euro yen position, worked out to my favor very, very well, and then started moving against me. I think it was a 50 pip move to my side, and then sharply started moving higher. That was the exact bottom of the Euro yen position. Now, instead of me exiting my position at the suggested stop level, I decided to keep moving my stop. After moving once or twice, it gets to a point where you no longer have a stop. Now the stop is mental. So I'm going to manage this trade depending on how it plays out.
And how you feel.
And how I feel. And if I only knew that how I feel wouldn't help me recover my money, I'd have made a better decision.
True.
So the first thing that I think is important for any trader to learn is to learn to take losses.
Exactly.
Yeah, if you've not learned how to take losses, you can't even stay with your winners. You can't trade successfully in the markets. Learning to take losses is a prerequisite of good trading.
They say like you have to learn to lose for you to win.
Exactly.
So if you don't want to accept losing for the early years of your trading, most likely that win.
You won't even learn how to trade.
Exactly.
You can't learn how to trade if
you need to wire your brain to. You see how you go to a closer trade.
Yeah.
Close trade, then it's negative something. You should be very, very happy closing that negative.
Exactly.
No second thoughts.
No doubt. No pain. Yeah.
Exactly.
And the only way I think you learn how to lose is through losing. You can't think about it and learn. Exactly.
You lose like 10 trades.
You lose until you get to a point where by now losing doesn't interfere with your decision making.
Yeah.
Like you're very, very objective when you're making decisions.
Yeah.
If I'm losing, it's okay. If I'm winning, it's okay.
Yeah.
There's nothing that affects.
Like you're not married to your trades.
Exactly. You're very, very objective, and you can stay out of positions when they're not working. You can stay in positions when they're working.
They're working, yeah.
Before you learn how to do that, like, please mark my words. If you have not learned how to do that, you won't succeed as a trader. Because once you accept now losses, you understand that you lose. Now it becomes very easy for you to position size in the right way.
Yeah.
To set your stop losses objectively, to exit your positions once markets are not working, not to come back and revenge trade. Like, learning how to lose will save you a lot of mistakes.
Yeah.
It will keep you from doing very many mistakes, which many people keep on repeating in the markets.
Yeah.
And that's very, very dangerous. So for me, I think I've learned how to lose through losing. Like, it just didn't come automatically. Like, I remember seeing $1,000 vanishing to nothing.
Yeah.
You have a position that's working to your favor, then that's reversing and you lose a big sum. You execute a position and you lose $300 for one. Like, I lost a lot for me to learn how to lose.
Mm-hmm.
But eventually now, I think I'm comfortable with losing, just like I'm comfortable with winning again. None interferes with my decision making.
Yeah.
I'm very, very focused on the process of trading. I'm not interested in either the win or the loss. I'm just interested in, did I execute this trade at the right place? Did I execute it at the right time? Did I place my stop loss at the right place? Was there an opportunity for me to capitalize? Did I miss an opportunity? Those are the questions that bug me. Not did I win or did I lose.
Sure.
Those ones don't interfere with my decision making. So anytime I'm trading, I know the objective of trading is to make money.
Yeah.
But you won't make money if you're attached to the money.
Exactly.
You have to learn to detach from the cash and just focus on the process of trading. That way you'll make very, very good decisions.
Good decisions, yeah.
Yeah. If you if you're still attached, because if you're attached to the money, there's a high chance elements like greed will still be with you.
Yeah.
Hope will still follow you in your trading. Like, you won't be objective when you're trading.
So detaching from the money.
Yeah, detach from the money completely. Like, a loss is a loss, a win is a win.
True.
Doesn't affect how you make decisions.
True.
And I think also one thing that has really, really helped me to learn some of these things is also thinking about, I'll be trading for 10, 15 years.
Yes.
Now, will some habits be positive or negative in that?
True.
Because I remember there's one, this is a good one. There's one good trader called William Eckert who says, the reason why you're so focused on trying to interfere with that trade is because your brain tries to show you that this win is the most important. You have forgotten the long-term distribution of your wins and losses is what matters.
True.
Like, the trade you have at the moment does not really matter.
In 15 years, you can't remember one trade you took in 2020.
And if you do, you are not trading objectively.
Yeah, true.
You can remember a period, but not one specific trade.
And the trades you'll most likely remember will be your biggest losses. Me, I'll never forget my oil trades.
The blow up,
exactly, the blow ups.
Exactly.
So like 1 or 2 trades don't really matter.
So
it's the distribution of as you said,
exactly. So it's,
and one blowout will stand out of that distribution
of trades. Yeah.
If you blow out, it will be the standing out trade for your life. So I think also on losing, there is also the fact the fact of losing objectively.
Yeah.
Like, yes, you're losing, but what amount are you losing on a trade? Are you losing 5% on a trade? Are you losing 20% on a trade? And I think that's where loss traps comes in. It's so hard for you to tell me you've been trapped into a trade that has had a exposure of 1 or 2%.
Yeah.
But most likely you'll find that this person was trapped because the trade had a very big exposure, like
he was
10%.
very invested in the position.
Yes, exactly. So like for me, my oil trade, one mistake also was I was exposed too heavily on one trade, on one setup, one entry. See, so like that lack of exposure control really, really magnifies your losses. So, and I think that's where now loss traps comes in, because even without moving that stop, already I'm risking 10% of my account. Now
so it's like you're starting from a place where you invested emotionally already.
Yeah, like
this trade has to work out.
Exactly, it has to work out. If it doesn't work out psychologically, I'll be
off.
Distorted.
Yeah.
And the moment you're distorted, that's when now the loss traps comes in. You start a trade negative 10% down.
Yeah.
Most likely you'll adjust it because you feel like, let me just adjust to 15, then it'll come back up. Also, it's because and I've said this before, it's harder to close a bigger percentage than a smaller percentage, even just 30 minutes ago. If I was down 30 minutes ago, 5%, then 30 minutes later I'm down 10%. It will be very, very hard psychologically for me to close that 10% loss. So I now get into that loss trap. I'm now starting to get hopeful.
Yeah.
Because I was trading maybe a system. I'm not a system, but a strategy that I know I trade it.
Yeah.
But now, since this trade, on normal occasions, when you're not overexposed, you'd have let that trade just hit your stop loss if it was a 1% risk. But now, because you see, now it now shows you the money factor.
Yeah.
10% of your money is a lot than 1%.
Yeah.
Let's say I was risking $10. If I'm risking 10%, I'm risking $100.
Yeah.
See, so cutting that $10 loss is easier. I'd have accepted it, and that's the first point. I evade the loss trap. So loss trap, I think it majorly comes when you're actually overexposed in markets. So I believe if you want to first avoid loss traps, the main thing is always know your exposure before you enter any trade.
Yep.
Always know where you'll come out before you enter any trade.
Yep. And understand that you lose objectivity once you're in a trade.
Exactly.
Like many people don't understand that.
Just
like,
before you enter the trade, make everything set first.
Exactly. Like mentally rehearse that position, how you trade it. If you don't do that, you are bound to make emotional
Just imagine, like
decisions.
before you enter that trade, just imagine I've entered this trade and the markets immediately are going against me to my stop loss. Am I okay with that? Okay.
Yeah. How much will I lose?
How much will I lose?
Yep.
Then you enter that trade.
Yep.
But the moment you've not thought about how much you lose on a trade, and how much you're willing to stomach emotionally, psychologically, most likely the markets will overpower your brain.
Yeah.
And you'll get into that loss trap. And loss traps, I think, I don't think people like easily come out of loss traps. As you've said, like if it was 10, 20, 30, 40, also from the analogy of recovering from drawdowns, it's way harder for you to recover from a loss trap, because a 30% drawdown needs you to recover by about 45%.
Yeah.
See? So it makes you like it's like a negative sum game, and we'll talk about that when we talk about drawdowns. So loss traps leads you to drawdowns, and those drawdowns are even harder to come out of.
Yeah. So
like I just think, like, if you want to avoid the loss trap, first of all, before you enter any trade, be very objective. Know your exposure on that trade, know where you'll come out, and most importantly, know how to position size. Because I've also like realized that problem with most people I'm teaching. Someone doesn't know how to convert that 1% risk into lot size. So yes, he wants to risk actually 1%.
But ajui
sasa lot size nitaipata aje?
Sasa hiyo sinaona ni lack of knowledge.
Yes, and lack of knowledge.
Anafaa tafute tu knowledge.
So like most people are not very invested in the knowledge. They're invested in getting the money fast.
Wow.
Someone is actually saving up more than reading more. You should just go and read, go and do analysis. Money will come if it will come.
Yeah.
Like
and if you're trading well, money will follow you.
Money will
That
follow
one
you,
I can
exactly.
assure you.
So like work so much on trying to understand how markets work for you.
Yeah.
Then the money will come. Like you'll be at a better place if you get funds later with a solid strategy.
Yeah.
And if you get funds now with a work strategy, you still blow the money. So I think the first thing you need to do as a trader is invest in knowledge, kabisa. Like invest in knowing how these things work. Invest in knowing the red flags of like how people get into loss traps, blowing accounts. Like read trading losses in history. Look at like Jesse Livermore. He says like he says the number of times he remembers like blowing accounts, it was just because of a simple mistake, not taking a loss. And he says that not taking a loss is what hurts the soul and the pocket. So like not taking a loss will most likely lead you to a blowout, and that blowout will be very depressing. Like no one is happy after blowing an account. That's why no one posts on IG that, hey, today I've blown 2 accounts. But everyone after winning, today I've doubled my account. Yeah. So also I think like the fact that the dark side of trading is not shown in the industry is the fact that makes most people not even learn from these blowouts. And I think that the fact that we are always out here telling people how we've blown accounts, I think our listeners now are at a better place to understand that, hey, this game is risky even for people who understand how markets work.
Yep.
Like you just make a simple mistake.
Trading is risky for I think it's risky for me. It's less risky for me because I understand how it works. But I can only imagine how risky it is for someone who doesn't know what they're doing.
Exactly.
Because the risks contained in the markets, if you don't know what you're doing, there's a 99.99% chance you will lose your money.
And I think I also like the fact that from my own research about risk management, like not so many retail traders talk about it. But look at the intensity of how institutional traders
Wow. And
talk of
authors.
risk. And authors talk
Like
of risk.
Nassim's work is all about risk.
Risk, man.
Like 4-5 books. It's about risk. Like tail
People
risks,
managing billions of dollars. I think it also
black
makes
swan
sense
risks.
for someone managing a lot of money to be more risk conscious than someone managing $100, $50. What you risk $50?
Trading
bro?
is about, if you think about trading, I think trading is about risk.
Mm-hmm.
At the heart of trading is risk. It's not
Yes.
about predicting where markets will go or
Mm.
getting the gold. I got the gold move from 1800 to 1850, or that's not really trading. Trading is about, I have $1.
How will I make it 2 and avoid losing
Losing
0.5 of it?
No, losing it. I don't want to even lose my $1. How do I make it $2 and mitigate the risk of losing it?
Yeah.
If you can think about trading in that form, then you can make better decisions.
True.
Because one thing that I've learned from Van Tap is, in the long run, trading filters out everyone who doesn't understand risk.
Yeah, true.
In the long run, after 5, 10, 15 years, the guy who's making big money but not understanding risk will be out of business.
Will still be out of business.
Yeah. But the guy who understands risk, how to manage it, when to take big risks, when to stay out. Because we're not saying eliminate risk. We are saying manage risk.
Risk cannot be eliminated.
Exactly.
At
you
any one
can't.
point. Even with the best mathematical models,
You can't eliminate risk. Exactly. But you can manage it.
You can manage it.
And you can manage it efficiently and in the right way. So for the traders out there, one thing that, and I think that was the question that I wanted to ask you, like for me, one thing that I normally do to avoid the loss trap, and I think I've not been in a loss trap for a very long time. I always have the worst level. At this point, I'm not even thinking about what I should be doing. Like I already know.
The worst case scenario.
Exactly. I'm out at this point. Like it's not something that I'm second guessing, or I think I just have a limit where if markets get to this level or if my account gets to this level, I'm out first of all.
Yeah, true.
That's it. Like I just have to, first let me be out. I'll think about how I'll recover, what I've done later. But kwanza acha nikae nje. You see, nisikuwa tena I'm thinking about it when I'm still in a position. That's one thing. 2, start small. When you're building your system, when you're building your psychology in trading, the biggest mistake you'll do that will interfere with your process of learning how to trade is taking very big position sizes.
Yeah.
And the reason you'll take very big sizes is because you're very invested in making money. You assume that you've just started out in trading and you should be making a lot of money. Trading will pay off, but in the long run, it's not a short-term game. Anyone who thinks with a short-term mindset is bound to lose again in trading. Because I remember like the guy who came to the office, there was this one person who had traded from, was it about $400 to 4 million? The guy who had gotten to 4 million started with how much?
10,000. He lost to about 4,000, then went back to 40,000.
40,000, yeah. But his position sizing was whack.
He didn't even understand how he was making this position.
So this was a person who was purely relying on luck to make money. And one thing I've learned in trading is, once you understand that it's one, there comes a time when the opportunities are so good, so clear that you can even take big risks and you won't be fearful. And you're just patient enough to wait for those periods to come. You'll make a lot of money. Like, now I understand when, a long time ago, I'd read the Market Wizards books and people, like, I remember Jim Rogers saying, I just wait for the money to be at the corner, then I'll go and pick it. I'm not really a trader. I'm just a speculator, someone who waits for very, very good conditions or opportunities to be present, then I'll act. And I've seen very many people talk about, in trading, 10% of the trades will make you 90% of the money.
Yeah.
In trading, 10% of the opportunities will make for you. Like, rarely have I ever seen someone who trades successfully, who, especially discretionary traders. If you're using algorithms like Jim Simons, I think you can do it multiple times, but that's an algorithm. But if you're trading discretionary, like you're making decisions, I've not seen anyone who's involved in the markets on a tick-to-tick basis, on a day-to-day basis, on a week-to-week basis, and makes a lot of money.
Yeah. You have you have to be out of the market a lot of times.
A lot of times, and that's what I was saying. Like the two ways to win: taking the winners, picking them, and avoiding losers.
Yeah, avoiding losers.
Not many people focus on avoiding losers, and the losing trades are the trades which have not aligned with your criteria. The bottom trades. Yes, you'll just lose 0.5. Tasema, and then lose to 1%. Okay. But keep compounding 1%, 1%, 1%, 1%. You find that in the long run, you've lost 15% on taking bad trades.
Yeah.
But if you're just patient enough to wait for the good trades, you'll make a lot of money. You get. So you have to balance the two sides of filtering out your losing trades and picking out the winning trades, which is a skill that is developed over time. And use of your journal, again, can really help when it comes to doing that. So in your journal, you'll notice the patterns of winning and losing trades.
Yeah.
Like for me now, I can tell a winning and a losing trade. I can't really tell it at the point of execution, but I can tell a trade which has a high probability of playing out. Because I've been trading for some time, I know the systems I use, I've never changed them. So I just keep on refining. And I can tell, okay, this trade will work. This one won't work well. This one will work to my target. This one I can risk some money, but it's not a very good position. Like you really have to think hard about how you're going to do such things for you to manage your trading. Another thing is you must have a drawdown limit.
Exactly.
Like for me, I know my drawdown limit is 30%. So once I get to 30% first, not that I'll quit trading, but first I stop trading. I understand that I've made very many mistakes for me to get to that level. I refine those mistakes, then I can come back to the markets.
Yeah.
Otherwise, there's no way I'll make progress.
True.
So I have a limit whereby if my account gets to this level, take a break first, think about things, then you can come back. You get?
True.
But once you're just trading and you don't have such limits whereby I can't lose, you could lose too. And again, I think even for the 30% one, it's the maximum. What I've learned with even the 30 is that you should have better levels. Like for example, now I think losing 10% is a big loss. That's a big loss if you know what you're doing and you're position sizing in the right way. So I'm really, really keen on avoiding such things. And I think position sizing is one of the ways to do that. Like I can't rely on picking the best trades for me to avoid a certain drawdown. But I know if I position size in certain ways, I can avoid going to certain drawdowns. And the account volatility is something you must be very, very, very careful about. Because if your account is very volatile, it means it's very risky. Your system. And the volatility could be to the downside. If it's to the upside, well and good. At least it shows that, because there are very many ways you can use to position size which help your upside and don't hurt your downside. So you can be creative around how you do that. And those are some of the things we teach once you come to our courses. Like we try to show you how you can be able to cap your downside while trying to maximize your upside. But if you've not thought about how to cap your downside, that's when you get to, like, I really find it funny when people don't trust in their trading skills. Like me, I know if you give me $1 million, I can assure you I won't lose it. Because I just won't lose it out of the blues.
True.
I'll have to make systematically bad decisions, and not just one, but multiple decisions. Like it's not just something that happens once. Unless it's a tail risk, it's not something. And tail risks are not something that comes very many times, or often. So, and I'm learning even how to manage some of those tail risks already. So you really need to think about how you're going to do some of these things. Because if you don't, there's a high chance you won't survive in the game long enough for you to make money from trading.
True.
Yep.
As you said on knowing your maximum drawdown limit. For me, call it the value at risk. Let's say you have an account, a $10,000 account. You're not risking the whole of the $10,000 account. You have a certain value that you're putting to risk. The other is to give you margin. So the fact that you have a $10,000 account, you're only comfortable to risk $3,000 of it. If you don't have that limit, as I've always said, you won't know that it's your time to go back and reflect. You'll still think, niko tu sawa. Maybe a few mistakes. If you don't stop there at 30%, most likely you'll go to 40%, right?
At 50.
At 50. But if you stop at 30%, that was your first value at risk. And this is how I try and teach people on risk management. You've lost 30% of your account.
Yeah.
That 30%, even if you do, ishaenda.
Hiyo huwezi urudisha hata in other things.
Kwingine. So for that account, that was your limit, right? At that point, like, try so much and stop trading.
Yeah.
I tell students, even if it's possible, move your money back to your trader's wallet, not in the live trade.
Okay.
So move your money back to the trader's wallet. Let the account be at zero, because it's so easy for you to get tempted to recover losses.
And once that happens, and you want to recover them quickly. Now you've messed up.
So most likely you'll be watching markets, and as I always say, markets are meant to fool you.
Yeah.
You'll see very, very good setups that are not there. Your brain is wired to show you what you want to see. So if you still have
patterns where there are no patterns.
So I still have your 70% remaining.
Yeah.
And a very, very good setup comes. You'll be very, very tempted to continue trading. But the fact that you can be very, very disciplined and tell yourself, this was my first value at risk. Let it go.
Yeah.
Move on from it. Sahau hata ushapoteza your 30%. Come back after a month or after 2 weeks or 3 weeks. Deposit your money back and treat it as 100%. Now have a 30% limit again of that.
Exactly.
Now you'll be coming into markets with a fresh mind, not trying to recover that 30%.
Yep.
You know, say, hey, I have now 100% of my money. It's I say $7,000.
Yeah.
Now you're now trying to work your way up with this $7,000.
Yep.
You adjust your trading plan slightly from the $10,000 back to $7,000, and you now start it's like you're starting out on still the same account, but like you're coming out with a fresh mentality.
Yeah.
I think that change of mentality is what most traders need.
Yeah.
Because at 30% down, your mentality already is that of a loser.
Yeah.
See, so changing that mentality to tell yourself, hey, let me now start on a clean slate. And try and understand what I can do different this time. You see? Like you've already now detached from the first time you were trading.
Yeah.
Now this is the second time you're trying to trade. You have another 30% limit, which is actually less than the first one. So I think that way it will make you survive in markets longer. Yeah. Because for most traders as they begin, evading that risk of ruin, that 100% loss is very, very hard. If you don't have these limits, it's so easy for you to come from a 30% drawdown to a 40 to a 50
until you lose everything.
Then it is to come from 30 to positive 20 to positive 10. You see, like it's so hard to recover losses.
Yeah.
Understanding that fact first will make you first have a very, very good relationship with your losses, because you'll know, hey, these losses, the moment they become many, it will be a headache for me to recover them. So you'll be knowing where to stop trading. You'll be knowing where to cut your position size. You'll be knowing where to cut your exposure per week. But the moment you still don't have this figures right, like having this data right on when you should do something if it happens, like pre-planned, not at just ending kupata by surprise. At just 30%, what do I do? Most likely you hadn't planned for it, so you'll still continue trading. But if you had planned for it on your first trading plan, if I lose 30% of my money, I'll stop. See, take a break. Livermore says there's a time to be bullish, there's a time to be bearish, and there's a time to go fishing. Like, get out of the markets, go and fish, go and play football, go and play PS if you want. Like, just get out of the markets first. Yeah. Like, detach from that first loss, then come back into markets.
Come back with a fresh mind.
I think that change of mentality is very, very important. And I think I've taught about a number of traders that strategy, and they think it's the best way to avoid a blowout. Like blow your account pole pole. That 30% first is your 100%, so blow it first. Then blow the next 30%, which is 100%. And you'll have like 4 or 5 times you're trying not to blow an account. Yeah. Then if it happens like that and you still blow 100% of it, most likely it will now show you, hey, this system, you need to improve on a lot of stuff about it.
Exactly.
So the fact that you don't have limits for your trading, like you don't know which threshold is the maximum for me to stop trading, trading will push you to 100%. Yep. Like there's no, I always say like markets don't have emotions.
Yeah.
They won't know that you're actually 50 as you go 50% down. When don't unajua. Markets don't know what percentage you are down. It's for you yourself to cut that loss. The markets will never like, hey, you know, Ken, to squeeze 30%, let's try and recover his funds. No. It will just continue doing what it does.
Yep.
Without thinking of you. So like the fact that you need to know that you're responsible for everything in your trading.
Yeah.
It really, really changes how markets work for you.
Okay.
So I think the first thing is get that responsibility for yourself. Like understand that I'm responsible for my own trading plan and to follow it also. Most people like have a plan, but following it doesn't shish.
Yeah.
Me, my blow in oil, I had a very, very solid plan.
But following
kidogo psychologically, mistakes, loss trap, unaitupa nje. So like losing objectivity in markets is number one prerequisite for losing. So the moment you lose objectivity, just know the markets will never like be humble for you.
Yeah.
They'll be very, very brutal. And you lose a lot without you, like if you don't go back to reflect, you'll continue losing consistently too.
Yeah.
But that detachment, that coming back to markets with a fresh mentality, I think it really, really helps you like to detach from the losses, because like it's so, and me, I'm telling you people from experience, like detaching from that 30% loss is not easy. Me had an account, I saw it from 20, 30, 50 until 95% down. See, and I was actually seeing it. Monday I'm waking up, it's
going down.
Yeah, the drawdown is going higher. Jana ilikuwa 30. Leo nashuka 25, unakuwa hopeful kidogo.
Narudi kwanza
35. So it fools you, by the way, it gives you some hope that actually we are coming back. Then you now start becoming hopeful. Another mistake people do now is they start averaging down on losers.
Whoa.
Now that's the biggest.
No, that's worse.
Like
never do that.
Like
never. That's a losing strategy.
That's a losing strategy.
Assure you that.
Exactly.
Like, never open another position once you have a losing position. Never ever.
It doesn't make sense at all.
It won't even work.
But psychologically, for people who have not faced that risk, it makes sense. Because this guy thinks, I'll recover faster. This is a bargain. I bought at 25, now it's at 20.
Let me buy.
Then actually I'm buying heavily. But by the time I go 25, break even, now this one has already made me profits. You see? So that mentality and I think it's just because people are fixed on the money, at the money side of trading.
Yeah.
Trading, I think for me, right now is not even about the money. It's about like clapping for myself when I'm disciplined. Even if it's with losers, winners, just clap for yourself. Every day you've traded objectively, exposed yourself well, clap for yourself. Even if you didn't make money, just clap for yourself. The fact that most people are always ingrained into the money factor. Ndo hataki, yani ameona loss imeenda, yani anataka kurecover that loss faster. I think the fact just detach from money, manze. That will really, really help you
make good decisions.
Exactly. So the moment you're still attached to money, the psychology of money, there's a whole book of psychology of money. So itakuchenga bana hiyo kitu. Money is very, very deceptive, elusive. And it will control your mentality if you don't know how to control it. So control like your views about the money in markets. So always have limits to your trading. Never average down on losers. Cut down that loser. Get back objectivity. As I always say, you're not objective when you have a trade.
Once it's running, objectivity
once it's running,
imeenda.
no objectivity. So it's very, very easy. Just cut that loss. The moment you cut it, you trust me, objectivity comes a lot.
Unaona kwanza hiyo setup kumbe inafaa kwenda.
Kumbe inafaa kwenda long, not short. You see, actually you reverse now your
position.
You now become long, and most probably you'll have now made a good decision to go long. But before you cut that trade will always convince you it's a good trade. Because it's your own decision. Before you entered, it convinced you it's good. So for it now to convince you again it's bad, it's so hard, unless you cut it. So like always like make objective decisions while being out of the market. And that also is on exposure control. Not just on one pair. Like of course you can be long on one pair, but already that pair is exposing your account too much. Even if you see another setup, you need to understand that I don't have exposure. You see, most people don't have these limits, exposure limits, risk limits. Like he's just trading. Set up a pound, yen, a lot of trades. Thinking, okay, he might think that these trades are well diversified. But the moment 2 or 3 trades now take full exposure of your trades, let's say you're risking 2% per trade and you have like 5 trades, that's like 10%. The moment just you're down 5%, all these trades now starts not making sense to you again. So you lose objectivity of the trades you had. So always before you enter any trade, before you enter into a new week, into a new trading day, know your maximum exposure also. Know that if I lose
this
4% of my money for the day,
market.
Even if another setup comes, I'll try and find exposure for the next week, for the next day. So also like to mitigate your value at risk, that 30%, it boils down to mitigating the 10% risk, 5% risk, 1% risk per trade. So if you don't have those limits, 1% risk per trade, 2% risk per day, let's say 5% risk on equity, like at any one point should your equity not be more than 5%?
Level, yeah.
I think that's where you create your discipline, because without having these numbers, without knowing that this is where I'll come out, you can't be disciplined to something you don't know.
Yeah.
So you need to know that this is where I'll come out. Now the next challenge is, will you be disciplined to do that? The fact that you don't know where you'll come out, you won't even be disciplined to know what to know how to handle that situation. And that's where loss traps comes in. Like psychologically, I think I don't think people realize actually when they're getting into a loss trap. It comes when you're actually down 50%, 60%. You realize, kumbe trade data. Like you're not even thinking, as you said, your brain freeze. Hata uko unafikiria tena. At 20, 30, 40%, your brain was not thinking. I understand the magnitude of loss you're in. I always tell people this, it's because you're trading a small account. Imagine having $1 billion, you're down 40%. That's a lot of money. $400 million. That's like net worth of a lot of big singers, Kina Drake. Una lose Drake on a trade. You see? So like as a trader, I think that's the main challenge for most retail traders. We've fixed our minds into small accounts. Losing small account, okay, lose from 100k, okay, lose 30%, you need 30k too. 30k ni kitu naweza recover by selling a few things, like a few of my assets. I say hata the laptop yangu ni more than 30,000. I can easily recover that. How will you recover $400 million?
But many people don't prepare themselves for trading big accounts.
Exactly. Like that's the problem. Like you have a very, very short-sighted mentality of how trading works. I think
and you're very invested in making hata uelewi kwanza unajifunza kutrade au jifunzi kumake do.
Exactly.
You're learning how to trade.
It also like for both sides. Someone with a small account, if he makes 50%, si pesa mingi. 50% of 100,000 shillings.
50k too.
Not to 50k, bro. For that person with $1 billion, like to 50%.
$500 million.
Unaona? Like umsa amechange life yake bana na investors wake.
Yeah.
So like for a trader also, don't frame your losses to just like your account size. Frame it in terms of percentages and think in terms of like you're managing a hedge fund, you're managing a investment firm. Fikiria nikiluza hata 10%. Ni squeeze 10% risk kwanza hata anaacha kwanza kutrade.
Yeah, and that's something that I wanted to say actually when you were talking. First things first. Your position sizing should have objectives.
Exactly.
That's one of the ways to handle drawdowns. And one of your objectives should be not to go into a certain drawdown. You get?
Exactly.
So once you're trading an account and in a week you've lost 15%, or in a month you're down 10%, it means there are very many things which you never did according to plan.
Yeah.
Okay? Or you are not really objective in how you designed that plan.
True.
And that's what I was saying. Like I still believe, and I still hold that belief, many people fail in their trading before they even start trading.
True.
Like they don't fail uko katikati, vitu ilikuwa ngumu. Ile tu mpango ulianza nayo ishakuangusha kwanza. Plan yako tu ukianza nayo ilikuwa nitakuwa nikirisk 2% per trade. Okay. Una risk 2%, hit rate yako ni ngapi? 10 ama 20. That means when you have 5-6 losing, and you have not even objectively designed a system which has very good trades and eliminates very bad trades, has a good hit rate, has a good risk reward ratio that you can capitalize on. What instead you do is you hope that things will work to your favor, or you position size with the idea that you'll make money in a certain way. Trading doesn't work the way many people assume, and I think that's the edge in trading. Once you understand that many people trade based on assumptions, then you can trade based on data and beat them very well.
Exactly.
Yeah, because many people trade based on assumptions. See, that makes sense. Okay, what makes sense to you from a thinking standpoint may not make sense from a trading standpoint.
Exactly.
So if you understand that, I think it's very easy now for you to follow some rules. It's very easy for you to avoid doing some things in the market.
Yeah, true.
Because you understand that, like one thing that many people assume is, asiezi lose 10 times in a row. Okay. Fanya back test uone. Utalose hata 15 trades in a row. Now, if you're losing 15 trades in a row and your position sizing is 1%.
15% down.
Yep.
To recover your 15% down. Yeah, my friend.
Kwanza hata usieke hata sasa money. Eka psychologically kwanza.
Yeah, psychologically.
Kujitoa kwa hiyo hole, it's not easy. Again, once you're in a drawdown, I think it's very... And that doesn't apply only to a drawdown. It also applies to the upside. As you get into a drawdown, it's wise for you to bet on recovering your drawdown based on time and not based on money.
Yeah, true.
Yeah. Say I'll recover my drawdown. Now I'm in a drawdown. It will probably take me 2 years to recover. But don't say I'll recover it very fast, but by position sizing in a very bad way. Because that's a recipe for disaster. But if you say, okay, now I'm in a drawdown. First of all, kwanza I'm cutting my size even now by 2 again.
Now it becomes even double harder to recover that loss.
Exactly.
Because when you're losing this money, let's say you're losing $20. Now
you're risking 10.
Now you're risking $10.
Yeah. You want to recover the $20 loss.
It becomes even harder.
It becomes harder. But at the same time, that's better than trying to recover using the $20.
Yeah, the $20.
Because that's a recipe for disaster. Because if you say, okay, let me just use... And the good thing about trading is the market's always there. So one thing you can do is you use just the $10, trade well. Once you recover to a point where you've recovered, let's say 25%, now you can scale up your risk.
Yeah, true.
Once you scale up your risk, it's very easy now to come back.
Yeah.
Because you can, like using the market's money, I think is one of the things that I've learned from OneTap. Like you wait for the market, you start trading. Once you're up 30%, you can take wild risks because you're not really risking your own money.
Yeah, true.
You're risking the money you've made from the market. If you go into a drawdown, you want to go into a drawdown where you lose capital. Let's go into a drawdown where you lose your profits.
Yeah, true.
And I'm not saying you start now taking wild risks ile ufala. I'm saying like you can scale up now. I was risking 1% per trade. Now I'm up 15%.
Yeah, true.
Now I can start risking 1.5.
What you're talking about is there are 2 forms of drawdowns. There's absolute drawdown and there's relative drawdown. So absolute drawdown is when you're in a drawdown of your own funds. Ulianza na 10,000
sasa umerudi
kwa 8,000. Relative drawdown is you had your account 10,000, made money to 15,000. Now you've lost back to 12,000.
Okay.
That's not relative drawdown, which is better to handle.
Yeah.
And it's not psychologically hard than the absolute drawdown. Exactly. Yeah. So also another thing to handle drawdown successfully is at least by starting right.
Exactly.
That's a very, very good... I think I'll tell most people this. The moment you want to start trading, make sure you're actually starting right. Like, of course you won't know if you're starting right or wrong, but before you start trading, like look for some small guidance too. Mseto utakusaidia tu risk management tu, uliza hii kitu mambo ni risky sana. Hii risk, how can we mitigate it? Just by starting right tu kiasi tu. Umekuwa hata 10%. You can now actually start like psychologically like your trading will not be psychologically harder than someone who starts lose 10% first.
Yeah.
Kwanza wa 10%, his main goal now is to recover.
Exactly.
Mwingine mwenye alimake 10% aka come back down to 5%, he's not in a really eager to recover the funds.
Yeah.
So absolute drawdown is, I think, the worst form of drawdown anyone can go into.
Yeah.
So if you're starting out to trade, like strive so much to start right. Like as you start out, your first month iko a positive month. Make to some funds so that it allows you now to trade with the objectivity of markets.
Yeah.
Now you're not pressuring yourself so much. You're not feeling like I'm the loser, you see? Because when you start and you go into absolute drawdown,
that feeling of being a loser, I think that's a mentality.
It's a mentality, but it's a fact. The moment you feel it's happening to you. So is that you have a bad mentality. Tuseme tu asa hivyo, exactly. So like you've attached your losses to yourself, which is not like that. Losses and winners isn't the consequences of the business you're in, not the consequences of yourself
or your decision.
Or your decisions. Like it's a consequences of the business you're in. Na hii business yako ni ya kumake profits and losses. So inafaa ujue hivyo kwanza. The fact that you're not at peace with that
makes you make very bad decisions.
You make profits, you think you know so much.
You make losses,
you think you're very, very stupid. Like that mentality is, I think, why most people actually become grandiose when they win and
fearful when they lose.
Yeah, fearful when they lose. So like try so much and like don't frame your losses to yourself. Frame your losses according to the percentages, markets happening. Like the moment you have attachment to your profits and losses, detaching from P&L, and I think I've listened to a lot of traders, and that's one thing that has helped them improve their trading, detaching from the P&L. Like wins and losses haziko affect. Ukikuwa na winner, you feel so happy. Yes, you feel comfortable, but hata ukiwa na losses, you always feel some type of way, but haiku affect like hadi in a cloud you're thinking. Even on winning clouds you're thinking so much, pia losing. So like you have to have a very, very good balance between understanding losses and wins. Na ujue see like they don't really show who you are. They just show like and not in one or two trades. In a couple of trades now they'll show your system how it's working. Like not it just show you like how you're handling this system. It will show you, hey, you're not handling risk well. You're not handling your psychology well. Like easily pillars of trading, not like pillars of yourself. Like you have your own self in trading. You have like your own personality. Then now you start creating a trading personality that fits you. You see? So like all these things are very independent. And the moment you start attaching yourself so much to your trading, I think that's now where you start also going wrong. The challenges are coming in because you actually feel like the markets should reward you. They shouldn't. Ajakupea ati assurance that, hey, come and do this business, I'll give you something. In trading, we are always striving to make alpha by actually managing risk. So understanding how you manage risk is paramount. That is actually, I think that this topic is an extension of risk management. Handling losses, drawdowns, and blowouts. It will be an extension of risk management. So risk management is the only way you'll avoid such things. Avoiding blowouts will boil down to
that's the only holy grail to trading.
True.
If you avoid such things, you can make money. If you don't avoid them, oh hell.
Risk management and like I think that's where most people also fail. Like they don't understand the concept of risk reward. And I think for me now the holy grail comes down to risk reward. You understand risk management
and risk reward.
Those two. The moment you have a very, very solid risk, because risk reward is understood risk management. So like I've just like boiled down into the exactly thing in risk management that will help you become a better trader. Exactly, because they're good traders making money with a poor hit rate but very, very good risk rewards. You're in the edge yao. It's like hit rate 40 and losing less than 50% of the times. In hit risk reward 1:3, 1:4. Challenge now comes in. Msaka risk reward 1:1, 1:1.5, 1:2 na kwa hit rate ya 20. Hit rate ya 20.
That's a negative system.
Hit rate ya 20 needs you to have a risk reward of 1:9.
But do you think traders even think about that when they're starting to trade?
No.
Nafikirianga market ni gold inaenda wapi?
Exactly.
Gold itafika wapi?
You've not dug so much to understand like the nuggets of your system, the hit rate, the risk reward, how you'll position size to meet your objectives, the pros and cons of your system,
the edge you have.
Exactly. The moment you still don't understand these things like in a solid framework, but those like things are happening very differently every time. Still like trading for you needs a lot of things for you to work. For it to work, I mean.
But trading is I think by the end of the day, as we conclude, I think I'd say trading is a long game. So trading is not a short game. I don't think again you can trade for 10-15 years and avoid drawdowns of 10-15%. Like even the best of the best have gotten big losses of 4-5%. That's one thing. Coming back from a loss is the test of a true trader. I think that's one thing that will really build you up as a trader.
Yeah, true.
The fact that you've lost money and you rebound from that and you come back and you go back into profitability and you make money, that's the true test of a trader. A trader is not someone who started trading and everything worked well. That's not a real trader. A real trader is someone who started, went back to zero, came back, and then went back to profitability. And I think there are very many examples of traders who even blew out, not even a drawdown, blew out 100%. I'm out of business for a couple of months, a couple of years. Then I come back and I make a fortune again. Livermore was an example. He blew out 3 times, I think. Yeah. Came back into the markets,
Millions
made a fortune.
of dollars in the 1920s, man. That was a lot of money.
That was a lot. You have just lost 50k na inakusumbua hata utakuangalia markets tena. Chief, haiwaki hivyo. Una lose, unarudi.
You have a wrong framework of loss.
Exactly. So that's the one thing I think I'd advise you to focus on. Anytime you think that you're losing, remember that that's the true test of a trader. Going through those periods and coming back is what will build you as a trader. Having that confidence that I went into a loss and rebounded, came back from it and made money, that is what will build you up as a trader by the end of the day. So your psychological framework will become better. You'll become more resilient. You learn to take losses. You become less emotional. Like there's no other way for you to learn how to trade. You just have to go to some places and come back. And I think that's a representation of many things in life.
Yeah, true.
As long as you're taking some risks, you're bound to make some mistakes. And as long as you make some mistakes, you're bound to fail. But if you learn from those mistakes, you come back, you become more successful, and you make a fortune if you're lucky enough in the markets.
Yeah.
So, but you have to keep updating on what you're doing. If you come back with the same framework, same mentality, you won't go very far. You really have to update what you're doing, reflect on it, and then come back and try as much as possible not to make those mistakes.
Yeah.
Anytime you see yourself doing the same things, that's insane. I think that's what Albert Einstein said. Insanity is doing the same thing over and over and expecting a different outcome.
Results, yeah.
So I think that will mark the end of today's show.
Yeah.
We'll see you again on the next one. But for now, peace out.